Hello, this is Jim Grice. I'm a partner with Brian Cave Leighton Paisner, and I lead the global data center and digital infrastructure team at the firm. Our team is a global team set up to be a multidisciplinary approach, providing us coverage from all aspects of the data center and digital infrastructure ecosystem. Everything from cradle to grave, whether it be capital formation and financing issues associated with supporting site selection, site development or construction of improvements, along with ongoing operations, leasing, asset sale and purchase and other types of dispositions, M&A transactions. And then we also have developed a key component of our team around some of these specialty skill sets, such as energy solutions, which includes procurement, facility development of energy facilities, telecommunications, network connectivity, etc. There's a pretty broad set of experiences that are needed to address this type of an industry, which is so important. We also try to organize our teams regionally with regional leadership, whether it be European leadership or leadership in our Asia Pacific area or US, where I'm based. And we feel this drives a unified approach across the multiple jurisdictions, giving us consistency of our service to our clients, and also ensuring maximum efficiency, and quite frankly, just develops some familiar and reliable points of contact with our service offering. Finally, we strive, and so to recap the whole thing, we strive to be a complete global solution for investors and developers, owners, operators, and users in the data center and digital infrastructure sector. Today, I'd like to talk with you a little bit about the data center industry. First, I'd like to lay out a few points on the market and really talk about how the market is comprised, and then move into kind of the impacts of the COVID-19 crisis. What is the new normal? How has it affected supply and demand? What kind of challenges are being faced by owners as they're trying to pursue these projects? What's the state of financing? What's the availability of financing and other capital markets? And then finally, I want to cover a few challenging aspects of the data center finance. What is a data center? Well, a data center is a purpose-built facility. The primary purpose of a data center, if you really want to focus on the precise thing that it creates a facility that serves the need of working servers where the apps operate and the data is housed. And to do that, it has to create an environment which is 24/7 reliability, 24/7 from a standpoint of connectivity to the internet, 24/7 from a standpoint of power supply, and also from a standpoint of the proper power supply, because spikes and waves in the offering of power can do damage to the servers. And then it has to be cooled. Servers create a lot of heat, and so there's a significant amount of infrastructure and systems around cooling the facility. For this reason, it's a type of facility that is very unique. It is becoming its own asset class, and it relies upon other traditional infrastructure assets such as energy infrastructure, telecommunications infrastructure, etc. But it's also kind of like core real estate. And for that reason, it is a standalone asset class and is becoming more so, but it's also not really like core real estate, and it's not really like traditional infrastructure. It is a combination of both. And with those unique challenges, it gives rise to a number of unique issues as far as how you develop, how you provision the facility, and how you operate the facility, which we'll talk about as we move forward. The state of the data center market. First of all, the data center market is a global marketplace. Data centers and data flows pretty freely, subject to a few sovereign data sovereignty rules that will govern from region to region. But I'd like to think about the marketplace as it relates to data center facilities and the hard infrastructure layer that drive the facilities. I'd like to think about it into two general classification of facilities. One is your traditional owner-occupied facility, a facility that someone builds for their own purposes, occupy it, and manage it themselves. The other is a facility that is built by a third party or is owned by a third party and is leased or otherwise occupied by another party, a tenant or an occupant. The separation of this ownership between the facility ownership and the occupant, who will typically own the servers, is what we call in the business colocation, or colo for short. Existing global data center capacity, when you take into account these two categories of data center facility, is pretty vast. At the end of 2019, existing colo inventory globally was well in excess of 6 gigawatts, maybe approaching 7. The reason I say that is because the 6 gigawatt number comes from research reports that I've had access to that only takes into account the capacity for the US, Europe, and Asia Pacific. Well, of course, that leaves out China. It leaves out other regions of Eastern Europe, Africa, South America, and even Canada. That's why I think that number is a fairly conservative number. But keep in mind what that number represents. 6 gigawatts is 6,000 megawatts. And that is a lot of data center capacity. The other component, which I referred to earlier as the owner-occupied component of the world portfolio, is really hard to nail down. In part because most of the owners of their own facilities don't release those numbers publicly very much. Some do, some don't. But it's really comprised in large sense from the large cloud operators, and they are definitely very confidential about their numbers. But I'm guessing that we're probably talking about at least half as much as the colo inventory is probably at a minimum. There's at least 3 to 4 gigawatts of that capacity. Maybe just as much as the other. But the bottom line is we're talking a massive amount of capacity that is growing globally. And then that brings me to my third point. The connected world is driving demand for more. We have a big critical mass of facilities worldwide, and the expansion of 5G, the exponential increase in the number of connected devices, artificial intelligence, machine learning, driverless cars. The list of demand drivers goes on, which is driving the large percentage increase in capacity worldwide. And the other factor is the COVID-19 impact, the most recent work-at-home movement, which has given rise to a tremendous amount of utilization of services that were not used nearly as much in the past. So what's driving the market? Well, there's a number of things driving the market, as I alluded to earlier, but hyperscalers really drive the market. And some of you may be familiar with the term hyperscaler or what a hyperscale user is. Others may not. So let me kind of break it down. A hyperscaler really is the folks that are developing large-scale public cloud facilities, the cloud service providers. That's Amazon with their Amazon Web Services product, IBM, Google, Microsoft, Azure. In China, you have the Chinese operators such as Alibaba. Then you have the internet companies who are building portfolio of data center capacity to serve their own needs, such as the social media operators like Facebook, Twitter, and others. eBay uses their own portfolio to house their own operations and applications. And then we have the emerging CSP and internet companies. These are folks that may not be as big and as material in the marketplace as Google and Microsoft, but yet they have built a business model that utilizes a significant data center portfolio for their business to operate. Spotify is a good example, Snapchat, and others who are listed here. There's probably others that we are not including on all three of these categories because the digital economy and the digital infrastructure that is needed to facilitate that continues to grow. This next slide, actually, I included this to just further elaborate on how the hyperscalers are driving the marketplace. This is off of the Microsoft public website, and it talks about their cloud region expansion. And all of the cloud operators, the public cloud operators, provide cloud regions. And they establish a region, and when they establish that a region, what happens is it starts to catalyze the region to grow more. So Microsoft has over 60 cloud regions that are publicly announced. They have more, but some of them they keep very confidential, as does Google and Amazon and maybe Alibaba. But this slide is intended to indicate that since the first of the year, this year in 2020, they have announced Mexico, Spain, Italy, Poland, Israel, Qatar, and New Zealand. And so that means that those particular areas of the world are now going to get a lot of attention from developers who want to develop colo space to accommodate the overflow demand for capacity that Microsoft will have in that region. And like I say, similarly, the other cloud operators will be doing the same thing. And this is just exemplifying how the cloud really kind of leads the development, why the hyperscalers lead the industry, as I indicated before. So as you can see here, this is an excerpt from some market data that was put together around the U.S. and the European market. EMEA stands for an acronym for that region of the world. And this is pre-COVID-19. This is data through the end of basically to account for 2019 and the periods prior. And what this is indicating is that prior to COVID-19, we were expecting and were projecting 23 to 25% annual growth for the for the hyperscale cloud operators, cloud service operators, and then for other enterprise users such as big corporations that may have their own data center operations that they do not want to place in the cloud. Those folks are growing, but they're growing at a slower pace. This is the Cowen research report, and it's projecting growth closer to a 4.5–5% range. But nonetheless, both are growing. But this also exemplifies the discrepancy in growth that the cloud, that the hyperscalers are driving. So what is the new normal in the post-COVID-19 environment? Well, the virtual environment is here to stay. It has caused global demand for data centers and digital infrastructure to accelerate quite a lot. We all kind of experience it. We all contribute to it. And it's such an interesting phenomena that we would have the COVID-19 virus have such worldwide impact. So everybody has had to live through the stay-at-home orders, and so everybody's had to learn to work from home or work from a remote location when formerly they wouldn't have done that. As a result, you've seen companies like Zoom, Webex, and Cisco seen a 100% increase in their demand for their service. You've seen network operators report 20–30% or more increase in demand for internet usage. Again, this all kind of intuitively fits with what we all probably knew was going on with our own personal habits and our own personal work environments. But as a result of that, we're going to see new protocols around data security and data center security in particular, with the physical structure. The utilization of how the employees are going to interact within the data center is going to give rise to a more amplified focus on the human element of data center facilities management and site access. There's an interesting story that happened with one of the large operators in New York, where as a result of the COVID virus and some of the mandates that were handed down by the regulatory officials, they were restricting access that tenants could have to their servers, and that gave rise to a lot of dialogue around access rights, which will find its way into contracts as we go forward. And then also what we've seen is from the enterprise side and from the hyperscaler side, a need for stability. So what you've seen is enterprise tenants that, they may need to consider committing on day one to lock down new and expanding capacity in a particular facility if they want to grow in place. Same thing with the hyperscale folks. They need so much more capacity going forward. They were already projected to grow 25% a year. I haven't seen a published growth rate, but let's say the growth rate went up to 25, 40, 50%, then it means they need to commit earlier and more often. And so you may see parties good ahead of the new demand curve and accelerate lease renewals so as to avoid the risk of someone leasing the balance of the facility where you want to expand. So then in the post-COVID environment, what's the supply demand? What has happened to supply demand? Well, hyperscale demand before COVID took up 80% of the European demand, comprised 80% of the European demand in the European market. That's a lot. And COVID-19 has merely intensified the demand for cloud services and hence the demand from hyperscalers in the data center capacity. Again, as we see this demand supply offset, it will trigger some different type of consuming habits from the hyperscalers and decision making. In the enterprise or wholesale demand, as was referenced on the slide earlier, many operators who are catering to the needs of enterprise users have seen an uptick in renewal and lease expansion, just like was indicated before. People are trying to lock down their space, lock down their expansion capacity, so as to eliminate uncertainty. But what this segment is going to be vulnerable or more vulnerable to credit risk of the actual tenant. So from a user standpoint, they're going to have to deal with that, and that'll have to flesh itself out. Some of the experts are projecting that that'll take probably into the first quarter of next year before we'll start to see that. But what's going to happen is we're going to see supply chain delays. and which will delay construction and delivery of space, pushing up against a heightened demand. And so it may intensify some of our contract negotiations. It'll intensify some of the terms. It'll change some of the terms that will have to be agreed upon. And it'll really kind of change the risk underwriting. If you're on the building and development side, maybe you'll benefit from accelerated commitments. Maybe you won't. Maybe you'll be burdened by delay in construction and jeopardizing commitments because they need that capacity. So we'll have to see how that fleshes out, and that's what a lot of the experts are saying, is that it'll be a while. Supply is likely to pull back in markets, some of the bigger markets in the world, like the San Francisco Bay Area, Northern Virginia, Frankfurt, and Paris. And again, we're going to see this interplay between supply and demand because of supply chain. But I think this is an interesting comment. I share it with you because I've gotten it from some of the expert research reports that I've read from the CBREs, the Joan Langs of the world. They don't think that the pricing dynamics will change materially. I don't know. We'll see on that, because it occurs to me when you have material changes in supply-demand forces, that pricing might change, at least at an intermediate time frame. So future challenges for owners in a post-COVID-19 environment. One of the things that seems to be the consensus in the industry is that enterprise IT budgets may be constrained due to uncertainty of just the business plan of the enterprise operator. You know, someone that operates in a business and uses their IT platform and their data center to support their business, but it's not their business model. A lot of the hyperscalers, the data center is their business model. So therefore, their demand is in the cloud as access to their cloud services. But a bank or a hardware store relies upon the data center in a much different way. And so in that regard, the uncertainty in the economy will, their IT budgets and their overall budgets are being constrained by the economic conditions worldwide. So therefore, this will create a little uncertainty. It might require projects to go back through budget approval. So from an owner standpoint, you may have a little uncertainty on you may have an enhanced churn with your tenants, and you may have delays in your tenant commitments, or like say, heaven forbid, you may have to get a new approval or a reapproval. Tenants will likely be more stringent in vetting the new data center providers and facilities that they choose to work with. The one thing that's come out of this is that we have really accelerated the reliance upon our data center footprint globally. Most every industry has experienced this. And so as a result, even mission critical has become even more critical. And so the performance standards that will judge who are going to be adequate operators and who are going to have adequate facilities will intensify. We will see an increased focus on maybe credit quality of the operators and as well as the financial position, experience, and operational track record. Business continuity plan for pandemic environment will become a higher priority review for diligence of operators to confirm that they meet your standards. And then just turnkey bill support, timely access to supply chain, and other aspects of what the operator can bring to the table. Enterprises will require more agility, and owners should plan ahead for new builds just to accommodate supply chain delays. And then finally, there's going to be more and more scrutiny on mutual force majeure clauses. I think we're going to see service level agreements. I referenced that in the slide as an SLA. Will probably come under further scrutiny and negotiation, and terms will become maybe more evolved than they are now in the normal marketplace. Termination portability options and legal and privacy implications all seem to be terms that will probably find their way to the top in a post-COVID environment. State of financing in a post-COVID environment. Well, it's probably no secret to anybody in this listening to our presentation today that data center REITs and the data center REIT sector has far outperformed other asset classes. The digital realties, the Equinixes of the world on the publicly traded markets have been making all-time highs as a result of this COVID-19 crisis. And as have all the other data centers. Those are just two names that I mentioned. Increased global demand in data center and digital infrastructure from institutional investor sources is on the uptick. REITs, private equity, pension funds, sovereign wealth, etc., all have expressed interest either in expanding their exposure to the space or creating exposure to the space. And but all of this is happening at the same time. Deal making is likely to become slower and more complicated. On-site due diligence is probably going to be something that's going to be very difficult. Travel and travel budgets are going to impact the ability to expedite diligence. And so we're going to have to kind of work ourselves out of this process. But it's not a bad thing that we have increased investor interest and that this is becoming a more popular asset class, which will facilitate ultimately more efficient transactions going forward. Also, there's currently a shortage of debt sources and debt pricing has become higher. That's probably a very temporal situation and it will work itself out over time, but it's the reality we're dealing with now. Finally, more enterprises will likely pursue sale-leaseback transactions and divestiture scenarios. And this probably is self-evident why, because there's probably going to be, from an enterprise standpoint, a desire to come up with possibly more liquidity. And also, interest rates are lower, the asset class is more popular, the pricing is probably more favorable today than it might have been 2 years ago, or even a year ago, or for that matter, in some cases, 6 months ago. So the economic basis for that will be better. So finally, what are the challenges for these new entrants into the market for financing and underwriting? As I mentioned earlier very early in the presentation, this is a very unique asset class. And because of its uniqueness, it has different types of risk factors. So as we see more people show up to either expand their footprint or create a footprint in the investment pool, in the investment world, they have to deal with this status of in-between status between core real estate and traditional infrastructure. And as we see people come from the infrastructure world, they're going to want it to look like traditional infrastructure. And as we see people come from the core real estate world, they're going to want to look at it another way. And so there's going to be a process, a learning curve, if you may, for those investors to get up to speed and really be able to pursue an aggressive investment pattern. You have unique contracting practices, again, that give rise to additional underwriting concerns and material terms that you have to understand. A lease versus a master service agreement versus a license. Those all can have very significant meaning, and a particular investor source can have a need for each. But really, this kind of identifies the need, the notion that we have a unique asset class, because it's very much a service-oriented provision in a multi-tenant data center. Some people are used to using licenses, depending on where their world came from, and some people coming from the real estate are going to be looking at leases. Those are very reconcilable, but there is, again, a learning curve and an underwriting question that has to be satisfied. Service level agreements are the separator between data centers and other commercial real estate properties, because service level agreements dictate the terms that an owner-operator has to agree to provide for environmental conditions, power, and network connectivity. Those are the big material provisions that are needed, and then there may be others that make the list that are maybe less important. But those are the ones that can cause termination of the lease. Those are the ones that can give rise to service level credits, which can be material as compared to the underlying rent. In some cases, it's measured by a credit equal to the rent that you would have received. And so it's a very material concern, and it's very important that folks that are looking to invest in the sector understand that. And as I said earlier, I think service level requirements might change a little bit in a post-COVID environment. So we have to be adaptable to those situations. Assignability may get impacted, again, back to the heightened standards of qualified operator status. Once they select an operator and they begin a project with an operator that they have vetted, then getting a new operator in there may be more difficult than it used to be in the past. Hence, assignability could be problematic if you're an owner of a data center and you're wanting to sell it and assign it to somebody else, and particularly if you're self-operating. Hyperscaler trends. This one's the tough one because they have so much leverage that they command terms that sometimes you don't expect and don't want, or for that matter, are not market in other contexts. Shorter initial terms is something that we see. Termination rights and termination for convenience rights, maybe with a buyout premium, hopefully with a buyout premium. When I talk about the compare and contrast between a lease and a license, this is where the hyperscalers kind of push the envelope sometimes with what would otherwise be considered license terms that include termination for convenience on very short notification periods. But as you go to the extent that investor sources are looking at this world, these are things that are going to come up, and these are things that, from a user standpoint, it's good to know that that these issues are playing in the background, because from a user standpoint, you may want to raise some of these issues in your negotiations as well. But I think I've covered the material that I was hoping to cover today. I very much appreciate the opportunity to share these thoughts with you. Thank you.